this week's market update. More volatility as tech stocks, corporate bonds and oil wobble. Trade is back in focus ahead of the G20 summit. Europe approves Britain's withdrawal agreement, and retail is in the spotlight over the Black Friday weekend. Another nervous week in the markets has left investors in an unusual place. The conventional wisdom during the long period of rock-bottom interest rates since the financial crisis has been that cash is trash, a guaranteed inflation-adjusted loss and a poor substitute for the long-term outperformance of riskier assets like shares and bonds. Well, that theory has been turned on its head this year, and cash is suddenly king. It now looks possible that short-term treasury bills, a close proxy for cash, could be the best performing of the main asset classes in 2018. The return from these bills at around 2.4% is not high in absolute terms, but it is higher than the total returns from most other assets this year. For the first time in years, cash is a competitive option for investors. Shares had another volatile week in the thinly traded days around the Thanksgiving holiday. The main US benchmark fell 3.5% last week, and the S&P 500 is heading for its worst quarterly performance in 7 years. Although better than most of its rival indices around the world, the S&P 500 is now about flat since the beginning of 2018 after a retail and energy-led rally yesterday. A key driver of the market's volatility has been the performance of the technology sector, most visibly the so-called FANG stocks that have been behind the US market's outperformance in recent years. The total loss from these household name tech stocks has been more than $1 trillion since their recent high points, as investors are focused on sales and regulatory fears. Interestingly, old tech is back, with Microsoft vying to overtake Apple as the world's biggest company. The performance of stock markets this year has caused investors to question one of the most profitable mantras of recent years: buy the dips. Throughout the long, decade-long bull market, it's paid to re-enter the market after any significant correction. The glass, however, has turned half empty as investors fret that recession, the usual cause of a bear market, may be around the corner. Some strategists are holding out. Citi's Robert Buckland says that only 4 of the bank's 18 bear market signals are flashing red, and he recommends staying invested in shares. He says it's too early to call time on the aging bull. But even he concludes that trying to squeeze the last returns out of the 10-year bull market may not suit less agile investors, and says that they should start heading gradually towards cash and government bonds. That will make sure that they have the firepower to buy back into equities at the bottom of the next bear market. It's not just shares that are suffering. Corporate bond funds have seen almost $6 billion withdrawn in the past week, as investors have worried about high levels of company debts in an environment of rising interest rates. Money has been pulled out of both high yield, so-called junk bonds, and higher quality or investment grade issues. The gap between the yields on those corporate bonds and government bonds, known as the spread, and effectively the extra income that investors demand for the higher risks involved, has widened to its highest level since 2016. Companies that have taken advantage of low interest rates to rack up record levels of debt are particularly at risk. One sector that's been in the bond bears' crosshairs recently on that front has been US shale oil. Companies in that area have been heavy borrowers in the debt markets, and they've been hit by the recent tumble in the oil price. The fall of as much as 30% from the peak in October of $86 a barrel to less than $60 has raised questions about the ability of oil companies to pay back debt. Another reason investors are adopting a more cautious stance than they have is the high degree of political uncertainty at the moment. At the end of this week, the G20 summit kicks off with all eyes on the planned meeting between the world's leading economic powers, China and the US. Presidents Trump and Xi are expected to discuss trade, but following the recent disappointing APEC summit, which failed even to produce a joint communique, expectations are low. Optimists are hoping that the two will be able to thrash out some kind of compromise to head off the planned escalation of trade tariffs in January. Unless there's a thawing of relations between the two countries, then the 10% tariffs on $250 billion of Chinese exports to the US could be raised to 25%. And that would obviously have a serious impact on global economic growth. Worse still would be Trump's threat, which he confirmed yesterday, to extend tariffs to the other $250 billion of Chinese exports. That would effectively put a levy on all trade between the two countries. Trade is one of the big clouds hanging over global markets today. Now, political risk is no less intriguing in the UK, where Theresa May won a notable victory on Sunday with the EU's approval of the withdrawal agreement that defines the terms of Britain's exit from the Union. Now, whether this turns out to be a Pyrrhic victory that brings no real benefit remains to be seen. First of all, the deal has to still receive approval from the UK Parliament, and the voting arithmetic there looks extremely unfavourable. That so-called meaningful vote is due to take place on the 11th of December. Secondly, even if it is passed by Parliament, the hard work is yet to begin. Once the divorce terms are set, the tough negotiations over the trading relationship can begin. In these circumstances, it's unsurprising that investors' appetite for UK assets has largely evaporated. Investors have voted with their feet and pulled more than $1 trillion out of UK equity funds since the referendum in June 2016, according to EPFR, which is a data provider. It's got to the stage where some market experts have started describing the UK as uninvestable because the possible outcomes are so varied and unpredictable. It's hard to engage in a rational analysis of the UK market. In short, it's become a punt. Well, a gamble it may be, but it does look like one in which the odds are increasingly attractive. Valuations have fallen this year, with the average UK share now costing just 12 times expected earnings. The dividend on the FTSE 100 index has only been higher once during the past 25 years, and that was in the thick of the financial crisis. The income offered by Britain's leading companies is now 4.3% on average, and that's attractive in an environment of low interest rates. Now, investors may be nervous, but consumers were out in force this weekend as the country joined in the US Black Friday shopping spree. The weekend, which also includes so-called Cyber Monday, when traditionally the online retail world joins in the fun, has become one of the most important periods of the year on the high street, right up there with Christmas and the New Year sales. Not that everyone is happy. Retailers who have experienced one of their worst years ever moan that the competitive pressure to offer attractive deals on this weekend means that many sales that might have been made at full price in the run-up to Christmas are brought forward in a heavily discounted and so unprofitable early sale. There's even been some scepticism about whether the discounts are really all they're cracked up to be. One study by The Which Consumer magazine found that 90% of discounts are matched or bettered within 6 months of Black Friday. Well, we'll have to wait until the week after the Christmas New Year break to get a sense of how the combined Black Friday Christmas shopping period has been. That's when traditionally there's a flood of trading statements. There's already been a few high-profile casualties of this theme. It would be surprising if there were not quite a few more.